Today, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing it to 2 to 2.25%. This action reflects the strength we see in the economy and is one more step in the process that we began almost 3 years ago of gradually returning interest rates to more normal levels. Looking ahead, today's projections show gradual interest rate increases continuing roughly as foreseen in June. The median of participants' views on appropriate policy through 2020 are unchanged since the June meeting. These projections play an important role in our work. My colleagues and I believe that it's useful to communicate our views on likely prospects for the economy and for policy. We are well aware, however, that the economy regularly surprises and that even the most carefully constructed projections are highly uncertain. The projections about the appropriate path of policy assume that the economy evolves broadly in line with the projections for growth, employment, unemployment, and inflation. If the economy were instead to falter, lower interest rates would be appropriate. Conversely, if inflationary pressures were to rise more than expected, higher interest rates would be appropriate. Right now, as our statement indicates, risks to the economic outlook appear roughly balanced. Readers of the FOMC statement likely noted that the committee dropped a sentence that indicated that the stance of monetary policy remains accommodative. This change does not signal any change in the likely path of policy. Instead, it is a sign that policy is proceeding in line with our expectations. We still expect, as our statement says, further gradual increases in the target range for the federal funds rate.